Perfect. Now, foundation of risk management, again, this is book 1 and chapter 2. How firms manage their financial risks. Now, I have already shown you the graph about which bank retains which risk. Banks love to retain credit risk, then operational risk, and then market risk. Now, every organization will have to decide which risk they want to take. If it is a software company, what happens in software company or IT company is that most of the money comes from USA. Now, when money comes from outside India, there is always a currency fluctuation risk. So, some of them hedge it. Hedge means they try to reduce that risk. Some of them try to keep it open. And that's the difference between, you say, Infosys and Wipro. One takes the risk, another do not take the currency risk. They hedge. Now, that is retaining the risk. Many other people, they try to put the value of the risk in the price itself. So, best example is prime customers and subprime customers. Prime customers are the customers who pay on time, who have very good credit score and all that. They're called prime customers. So for prime customer, bank gives loan at lesser rate, let's say 3% in US. For some prime customer, they started giving loan at 5%. This 2% extra they're taking is for their credit risk. So, pricing in the product means while giving loan, you take 2% extra. That is, you try to include the loss of risk into the price of product itself so that you need not have to suffer it yourself. Identifying non-essential risk and just get out of it. So during Russia and Ukraine war, you know that American companies might suffer. So there were many companies who just got out of Russia before even war started. Divestment or discontinuation. Organization may choose to discontinue because you are not familiar with the risk which is involved in that. Especially in war-torn regions, especially when you have dictators and all that. Generally, people try to avoid those, and that is divestment or discontinuation. Now, mitigation is reduction of risk. How do you try to reduce the risk or get out of the risk? Now, organization try to reduce the risk. Now, if it is a manufacturing company, they do not want their machines to stop. So they do preventive maintenance. That is a risk mitigation technique. So I know Bharat Forge. It takes almost 1 day to just start their furnaces. So if furnaces stops, their worker will have free day. So they do not want their furnace to stop. If it is a pharma company, they are worried about quality issues. So if pharma company, their tablets gets rejected, they suffer huge loss because of quality issues. So they try to invest in their quality control process. so that their tablets or their medicine should not get rejected. So this is strategic risk reduction. You put safety protocols, diversification. Yes, cyber security. Now, this is one of the biggest security concerns which many companies have nowadays. Most of the Indian government websites have been hacked by Chinese. Even the one from nuclear power plants also. So that is a risk. How do you transfer those risks then? You purchase insurance. So you purchase fire insurance, you purchase operational risk hazard insurance. So you purchase insurance, or you try to purchase derivative products. Now, what are financial derivative products? You have forwards, you have futures, you have options, you have swaps, you have mortgage-backed securities, MBOs, CDOs. We will see all those things. Don't worry. But these are derivative products. Derivatives try to reduce the risk. So do let me know next time if you are good with derivative, you know derivative, or you completely don't know derivative. Depending upon that, we will try to spend more time, less time on derivatives. So these are futures, options, forwards, swaps, contracts, which try to hedge. When I say hedge, hedge is nothing but reduction of risk. Now, consideration of counterparty risk. You always have to check how good is the counterparty. I'm not sure whether you have read the book Big Short or whether you have seen the movie. A small hedge fund manager who is a dentist by profession goes to big bank like JP Morgan and Merrill Lynch, sell CDOs there and ask that what will happen if you don't pay me? And he asked for mark to market. That means whosoever loses every month will pay the amount which is lost, so that you need not have to worry about complete loss, mark to market. And everybody laughed on him. That means if you enter into a contract for 5 years, now in first month, let's say there are two parties, A and B. A party lost 100, so A party will pay to party B rupees 100. In next month, party B lost 50. B will pay to A 50. So every month that will take place, so that at last there should not be a very big amount. And then these big companies like JP Morgan and Merrill Lynch, they agreed to market on both the side, and they lost heavily to this guy. He almost earned 450% at the end of 2008. Okay. Now, this is your expected loss. This is your unexpected loss. And this is for unknown. So your 200 million, you try to just say we only have 150 million, so we are ready to accept risk of 150 million. Another 20 million you keep for unexpected loss, and then you keep another 30 million for unknown loss. So that's how you keep money. Now, two things which are very important from risk profiling. This is called risk profiling. We do it with lot of individuals. Risk profiling of companies is very easy than risk profiling of individuals. ability and willingness. Now, I have a client whose age is almost 59. In next 2 years, he's retiring. He's retiring at 61. Do not have any savings. He is worried about his retirement. He came to me and said, my friends are investing in Bitcoin. I heard that every day Bitcoin gives you at least 10%. Can you create a carpos for me so that I can retire happily? What is happening here? His willingness to take risk is very high. What about his ability? His ability is very low. I have other clients also who are doing pretty well, who are in the late 25s, who are earning approximately 2 lakhs per month. They try to invest 50, 60,000 per month, and they say, like Rishi, it's okay if I do not get much returns, but please make sure that my capital is not lost. You invest in FDs, no? You invest in government bonds, no issues. Why you want to invest my money in equity? So, what is happening here? His ability is high, but his willingness is low. That's exactly happened with organizations also. And if their willingness is high and ability is low, you should not invest in risk. But if, just a sec, I need to charge my laptop. Just give me that. Okay, sorry. When willingness is high and ability is low, yeah. When willingness is, it's not working. Again, sorry. When willingness is high and ability is low, you should not invest his money in high risk products. That's unethical. But when ability is high and willingness to is low, you need to convince him, or at least try to convince him. Now, regarding organization, you find that new organization startups are willing to take high risk, but they do not have ability to take high risk. But because they're willing to take high risk and they're ready to shut down their business if business does not work, sometimes they take aggressive decisions. While ability, if you find a old company does have a higher ability to take risk, but they do not want to lose their position. So sometimes some company takes high risk, most of them do not. So please understand the difference between willingness and ability, and they are part of risk profiling. There will be a lot of questions on risk profiling. Okay. Setting risk levels. How much maximum risk can you take? If there are errors, how you need to cover that error. You need to do cost benefit analysis of risk. So it so happens that many times the loss is less, but the cost of avoiding risk is high. Now, example, Amazon packaging. Many times the customer gets wrong package. So if its value is less than 1000 rupees, Amazon will directly refund you 1000 rupees rather than trying to find out where this package went, how he could not receive the package, what happens to his package. They will try to find out, but the cost of finding out is more than the value of package. So they will generally try to give it out for free. That is the cost benefit analysis. Stakeholders. Stakeholders are the people who are working with you. They are your creditors, they are your debtors, they are your customers, your employees, investors. These are all your stakeholders. Now, they should consider the risk preference of their stakeholders also. So, for a company which is owned by people who live on dividends itself, like Tata Sons. Tata Sons is a company which is the conglomerate of all Tata Group, and they give 75% of their money to charity. So how do they get money? They get that money via dividends. So every Tata Group company generally pays some dividend. So that's the risk preference, and we respect that. It's okay. Employee engagement. Risk cannot be reduced without employee taking parts in it. Now, if you see, most of the insurance companies, the idea is first the employee should fill a form and then the customer should sign it. But what happens? Customer first sign the form and then employee fills it. If something wrong happens and it is found out that the employee has taken signature first before filling the form, it is a criminal offense. And the person who has signed can take out hefty money from the bank or from the insurance company. But if you see, there is so much pressure on employee to perform that he will first take the signature itself. Now, unless your employee are with you on the risk management, you will not be able to completely mitigate the risk. Okay, you need to communicate it to all stakeholders. How do you communicate the risk? Nowadays, in Western countries, it is compulsory for you to speak about your risk on your website itself. Then you need to tell it to your stakeholders, including employees, customers, investors. They should understand which risk the company is taking and which risk they are not taking. You should communicate it in your statements also. So there are two types of statement: qualitative and quantitative. In qualitative statements, you do not use facts and figures. In quantitative, you give facts and figures. So, pharma company may communicate risk appetite by rigorous research and development process to ensure safety and efficiency of its products. So, this is qualitative. What about quantitative? You provide them about war. This much risk we are taking. This is value out of risk. Or key risk indicators, KRI. So VAR is a key risk indicator. So is standard deviation. If you are in portfolio management, drawdown is your key risk indicators. Now you must communicate it to the creditors also. Now creditors are your banks who gives loan. So you must be transparent with your bank. You if you are transparent and if bank feels that you are good, then the chances that your credit rating will also be good and bank give you loan at less cost. You try to maximize your shareholders value, then maximize profit maximization and wealth maximization. So it's not profit maximization, you should always look for wealth maximization. Okay, now who should set how much risk we should take? Risk appetite should be set up by board of directors, higher level management basically. The risk policy, the board should be there and they should work on risk policy and framework. So they should create a policy that not if it is a bank, let's say if it is a bank, if employee is transferring more than 50,000 rupees, it should be confirmed by the manager of a bank. What is happening? This is your risk policy. Now there are some other banks who says every employee must take 1 month leave. This is generally in portfolio management, investment advisory, and all that. Compulsory 1 month leave. So when someone else comes on his place, he will understand what wrong he is doing. So every year, every employee must take 1 month continuous leave. This is again a risk policy. And many people or many companies follow this. So the board of directors should make all these things so as to reduce the risk. Yeah, we have just seen reviewing the risk assessment, the review. So basically, they make the processes, take the feedback, they change the processes, and then again they implement it. They again take the feedback. That's the cycle. Now, the board must monitor key risk, war of the complete company. This is one of the key risk factors, right? Now, if it is an software company, they try to find employment retention, they try to find revenue per employee. These are all the risk factors. Depending upon the industry, they change. Incorporating risk in decision making, yes. So most of the decision making takes place with the help of capital budgeting. Now, new tools which include risk in capital budgeting, they are in the market. So the board of directors should consider risk while doing their long-term decision making, asset purchase, new plant installation, anything which is for long term should be risk adjusted. Does that mean short term should not be risk adjusted? No. Whenever you are doing any processes for long term, it should be risk adjusted. In the short term also, if you are following the processes, it should be risk adjusted. So for any major changes, it should be risk adjusted. And you should always take feedback. So this is basically feedback. You should communicate it to all the shareholders and you should monitor it always. So I'm not going to spend much time on it. Mapping, yes. It is very important to map the risk across the organization. So you must find whether it is a market risk, whether it is credit risk, whether it is liquidity risk, operational risk, or any other risk. Now, if it is a credit risk, how we can mitigate it risk? Should we use derivative products to mitigate the risk? Or should we take insurance against it? No. First of all, this complete thing is called risk mapping. So first of all, you identify and categorize the risk. You assess the probability. So what's the probability of this risk happening? What's the probability of this risk happening? I will teach you about war breaches. We will see about war breaches also. So if you want, we can do it today also, but let the concept of war sink in. So if value of war is 100, so you see in the last year, how many times this value of 100 is breached. So if value of 100 is breaching more than 4 times, then it is dangerous for you. Basel 3 allows 3 times. So probability and impact. You're trying to find out how you map the risk. So what are the tools used for mapping? So generally, if it is loss, you use heat map. सबसे ज़्यादा loss कहाँ पे हुआ है? Where is the maximum loss? Or you use charts to show, okay, marketing risk is this much, operational risk is this much, market risk is this much, and so on and so forth. Now, once you identify, map the risk, now you try to find out how to control the risk. So either you use derivatives or you use insurance or you get out of that market. That's how you can mitigate the risk. Hedging, yes. In level 2, you will have almost one book only on hedging. So hedging is reduction of the risk. And mainly hedging is done with the help of derivatives. Fine.
Sir,
Yeah.
Shomanit.
Yeah.
Actually, I am from the banking side. So
Okay.
when at the time COVID period, I am saw many activities in the society is shut down,
Yeah.
and many of the areas their work is same. So particular the geographically the area is from the banking side, the credit risk is much high.
Hmm.
So this kind of risk bank suddenly it's hit our portfolio also. But after like after 2 years, these areas is become flourish, become they revive from their point. So now is it feasible to counting the risky part from the different angle, or like as the previous time? What is the view?
Okay. So if I understand your question correct, during COVID time, there was much credit risk, and now you do not have that much credit risk. Now you want to calculate the credit risk during COVID time, right? Backtest it.
Yes. Yes.
Yes, we can do that. So if you see the VAR technique, historical VAR, basically, it tried to do the same thing. So historical VAR tried to find out from the history about the various laws. The idea is history repeats itself.
Okay.
That's the idea. So if it has so if you see, now people are talking. People are saying that okay, there is a 90 years cycle.
Okay.
That 90-year cycle came in 1929 also. That came in 2019 also.
Mhm.
And before that, so maybe 1839 something. Yeah. So this 1839 was plague or Spanish flu. I'm not very sure.
Spanish flu.
Yeah.
I think so. Yeah.
Yeah. 1929 is Great Economic Depression, and 2019 is COVID. Now they are even try to model these risk which comes after 90 years. But
Okay.
before 2019, nobody was thinking. Now even they will model it for, let's say, 10 years, next 20 years, next 30 years, and then they will forget about COVID. Because new managers will come, they will say that okay, this is not very important risk from my point of view. I have not seen this risk. And after 10, 20, 30 years, they will forget about this risk. So
Okay.
maybe after 90 more years, you will find that the same thing happening. And they will say that, okay, this is an unknown risk. So unless that risk repeats itself after a specific period of time, you will start calling it as an unknown risk.
Okay.
You got my point? But
Yes, sir.
yeah,
Yes.
now many people are modeling for COVID, and you can do it by historical modeling. You can do it. We will see how to do it in when we will see about historical war. If you can remind me this, we will even see how we can find out extreme risk or black swan event in that case.
Okay.
Perfect.
Okay.
Yeah. So hedging is reduction of risk. It is done by derivative products. Now, few of the important point of derivatives. The most important point is leverage. So, if you want to purchase a stock of 100 rupees, you just need to pay 2 rupees. So, you're getting 50x leverage. And because of the leverage, derivative is used for hedging. Because you just need to pay 2 in order to get value of 100. Same is the case with insurance. You just need to pay 1% or 2%, and if loss happen, you will get complete 100%. So why these products are used in risk hedging is because of less cost. Less cost doesn't mean cost free. It's not cost free, but yes, it has less cost. Now, uh, let me take an example of the derivative products so that you will understand how derivative works. I'm going to take very simple examples. So on y-axis you have price, and on x-axis you have time. Or let's do one thing. On x-axis you have price, and on y-axis you have profit and loss. So this is zero. Above it is profit, below it is loss. Let's say You have a portfolio of shares, of one share. You have purchased that share at 100. Now, this is the line. What does this line signify? That if the price goes to 110, 120, your profit will increase. So profit will be 20 here, profit will be 10 here. Similarly, if it goes to 90, if it goes to 80, you will be in loss, minus 10, minus 20. So this is a simple payoff chart. Now, what if I draw, sorry, I will change the color, so that will be easier one. Just give me a sec. Okay. Let me change the color here. Green will do. Let's say I purchased something like this. If you know derivatives, this is called put option. So what is happening? I am losing just 2 rupees here if it increases or if the share price increases above 100. But if the share price decreases below 100, this put, I'm getting 10 rupees as profit here and 20 rupees as profit here. So what is basically happening here, that one stock which I have purchased, plus if you purchase one put on it, when there will be profit, your overall profit will keep on increasing. But when there is a loss, your loss has been taken care of. So minus 10 and plus 10 will be 0. Minus 20 plus 20 will. So you will always be in profit, but your loss will just be equal to the price of put which you have given. So you give 2 rupees for put option. So if the market goes down below 100, you'll only lose 2 rupees, which is called as premium. Shit. I don't know why is this happening. Just give me a minute. Okay. Which is equal to premium. So this is a classic case of hedging. Hedging means reduction of risk. Now, in order to reduce the risk of the stock, I have purchased one put, I paid 2 rupees for it, and all the downside has been taken care of.
Sir,
Yeah.
uh, for my understanding, when it's the derivative,
Huh.
I brought a stock at the rupees of 100.
Yeah.
So for the, if the price of the stock is increased by 110, so
Hmm.
my profit is 10. If
Hmm.
it is below 100, it is loss of 10.
Perfect.
So this is a derivative part.
No, you just purchase a stock, right? How can that
Purchase
be
a
a
stock.
derivative?
Yeah, no, then it in the put options.
Huh?
So how I am not understand this part. That is the rupees of 2. That
Okay.
is the put. Yeah.
Okay. So I understood your question. So basically, let's do this. Okay. So let's say this is a stock, and let's say this is a put. Sorry, my handwriting is not great. No, I will draw it the other way around. Yeah, let me draw it again. Okay, this is a stock. I purchased stock at 100, so stock will go like this. Let's draw another diagram. The put will go like this. Assume this is 100. This value is 2. Okay. This is put option. Now, what happens in put option? You have purchased put option with a strike of 100. So, if the price goes below 100, you will start making money. If the price goes above 100, your profit or your loss will be fixed by up rupees 2. This is how put option works. Uh, um, Before I explain you further, do you have any idea how option works? Have you seen it?
No, sir.
Oh, then my mistake. Okay, fine. So I will just tell you this. We will see options in detail. I thought that people are good with options. No, no issues. So this is stock. You understood this stock.
Yes, sir.
Similarly, put option works like this. Right now, just understand this. So the graph of put option comes like this, and the graph of
Yes.
stock comes like this. So here, with the help of put option, you see that you are in when you are above 100, that means 100, 110, 120, your profit keeps on increasing, but your loss is constant at rupees 2. So effectively, you are in overall profit when you are above 100. But when you are in below 100, your loss of the stock has been taken care by the profit of put option. We will see in detail. Right now, you just understand that put option works like this.
Okay, sir.
So this is how we do hedging from graph. So right now, I'm not going to tell you how put option came like this, because that's the definition of put option. When we will study put option, I will teach you that. But
Okay.
it will go like this. And look, our loss has been taken care of, and
2.
our profit has been kept as it is. So this is an hedging. So did you understand how I draw, or what's the hedging part in it? The hedging part is the loss is taken care of by the profits, and
Yes.
effectively there is no loss
No
except
loss.
the 2 rupees which
2.
we paid as premium.
Okay.
You got my point?
Yes, sir.
Yeah. Any other question from anyone else, or you will even in that case? It's okay if you have any damn question, because I will understand from how basics I need to teach. So I was under the impression that you guys know derivative, but don't worry, I will teach derivative from basics, right from future forward and all those things. Okay.
We
Yeah.
will also cover derivatives in the derivative section later in the book, right?
Yes, yes. We are going to cover, we need to cover that. So we need to cover the basics. Don't worry about basics of derivative. We will cover everything right from scratch.
All right.
Therefore, I am asking you guys to ask n number of questions. So we will know from how detailed we need to teach you. Don't worry about that. We will cover everything right from basics. Okay, now what are the advantages of hedging? First, risk will reduce. That's the definition of hedging, right? Reduction of risk is hedging. Improved financial planning, yes, for financial planning improves. Stakeholders has more confidence in you, that's given. What are the disadvantages? You need to pay cost even if you are using insurance, or you are using derivative, you need to pay cost for that. And that's the cost. Sometimes when now let's say how things works for home loan. So HDFC gives home loan, right? In India. The capital of HDFC is, let's say, 100 CR. HDFC gave 1 crore loan to 100 people. Its capital got exhausted. If the 101st person come to HDFC, should HDFC say, no, no, I do not have money, I will not give you loan? No, that's not how it works. So what HDFC will do, HDFC gave this 100 crore loan, let's say at 9%. So HDFC sell this loan to some other big bank at, let's say, 6 or 7%. And they take another 100 crore. They keep the difference between 9% and 7% with itself. That is 2%. And again, HDFC start giving loan of 100 crore. Now the people who purchase this loan at 7%, they're really happy with 7%. But some of these out of 100 crore, they will not pay back. So we try to divide this loan of 100 crore into different tranches, which is called as mortgage-backed securities, and it's trenching. So first tranche will get 9%, middle tranche will get 6%, and the last tranche will get 3%. These are interests. Now, they are getting 7%, but they are paying 9% to the first tranche. Why they are paying 9% to the first tranche? Because if some loss happen out of this 100 crore, that loss will first be absorbed by this first tranche. So out of this 100 crore, let's say first tranche is of 30 crore, middle tranche is of 60 crore, and the last tranche is of 10 crore. 60 plus 10, 70 plus 3, 100. So let me draw this in a different color so that you understand the trenching and other things. Okay. Now, again, HDFC gave loan of 100 crore. They sold this loan to some other bank at 7%. HDFC gave loan at 9%, so HDFC kept 2% with itself. Now, this loan of 100 crore will be divided into different tranches. Okay. Now, the first tranche, assume it's of 30 CR, middle tranche is of 60 CR, and the last tranche is of 10 CR. The first tranche will get, let's say, 9% interest, middle tranche will get 6% interest, and the last tranche will get 3% interest. Now, if someone defaults on this 100 crore, the first loss will go to this 30 CR or the people who have purchased this tranche. So let's say 1 crore, you're not getting your money back. So these people will suffer a loss of 1 CR. If your loss increases more than 30 crore, then let's say if you're out of this 100 crore, 31 crore was lost. So this 30 crore will get completely wiped out. They will not get even a single money back. And 1 crore will lose from this 60 crore. So these people will just get 59 crores itself. They will get the interest, but principal, I'm talking about principal. Now, people are worried that, okay, our money will not risk, we will not get our money back. So what they did, they purchased insurance. So this 7% they are getting, they give 1% to the insurance company, which is called as credit default swaps, CDS, which is nothing but insurance. What is happening? That these are AAA rated. Every house is AAA rated, backed by the value of house. So you are getting 1%, you are getting to give insurance on these AAA rated bonds or AAA rated houses, that if they defaults, you pay the value and you get the house. And you sell the house and you get more money. So you are now getting 1% insurance also. In case you had to give money if someone defaults, then you are going to get house and you can easily sell that house and you will get your money back. This is CDS, credit default swap. If you look from 2002, everyone started dealing in this CDS and they're willing to keep this 1% free. So what happened? The banks in US, they gave loan to customers. They go to credit rating agency, tell them that, okay, these are the houses. Credit rating agency will give them AAA rated. And then they're given to the tranches and 1% is given to CDS. Now, 1% of 100 CR comes out to be 1 CR. So without any risk, without doing anything, you are getting 1 CR every year. Without investing 1 rupee on an investment of 0 rupee, you are getting 1 CR. All the big corporates, big insurance companies, big kings, the king of Saudi Arabia, they all came into this CDS selling, which is selling of insurance. That is, if some of the homeowner, the defaults, we will pay. Why? Because there was no investment to be done and you are getting an income. It was first taken by all banks of USA, then it went to UK, then it went to complete Europe. Everyone started purchasing CDS. So what happened? When bank gives loan to subprime customers also, these credit rating agencies who works for very less fee, they started giving AAA rated because you have house as an asset back to it. So if they do not pay, we will get the house. And the prices of house were increasing like crazy. So every 6 months, the house price was double or was getting doubled. So like crazy, everyone purchased credit default swaps, which is nothing but they sold the insurance. Somewhere around 2007, these people started defaulting. Why they started defaulting? Because if you see the prices after 2006, the prices of housing loan did not increase or did not increase more than 5% and 10%, but they were expecting an increase of 100%. So what these people were doing, They were taking personal loan of 10% and 90% loan was housing loan. So many people in America took houses on 100% loan, assuming that in 1 year the prices will go up and we will sell. In 2007, it has been found out that the housing prices are not increasing. People are no more interested in purchasing houses at such a high rate. So these people who took 100% loan, they could not pay their interest and EMI. And because they could not pay their interest and EMI, they started defaulting. And suddenly, these people who purchased CD, they had to pay up because these people have started defaulting. The insurance company will have to pay, and every damn fool or every other company in USA, in UK, and in Europe had this CDS. The beauty is in 2007, in mid 2007, Iceland, Ireland, they still have kings and all that, and big companies, governments. They invested in CDS without knowing what it is. In 2008, even Prince of Saudi invested in CDS. So these banks, the banks of USA, UK, and Europe, they found out that the CDS spread is increasing. They offloaded it to Ireland, Iceland, Saudi Arabia, Dubai, and all over the place. And you know what happened next. So you just got 1%, maximum 2%, and you have to pay 100% on it. Shit. I don't know what has happened to it. Yeah. Okay. You have to pay 100% on it. Because of that, complete Europe got collapsed. UK got collapsed. USA got collapsed. And even this Iceland, Ireland, Greenland, Saudi, all of them suffered huge losses. And this is called subprime crisis. Why it is called subprime? Because subprime people who are not prime customers, who are already on default, the banks of USA has given loan to them to purchase house. So it is widely said that CDS is at fault in subprime crisis, which is a derivative product. Which is used to reduce the risk. But here, CDS has increased the risk rather than reducing the risk. Any question here? Perfect. No questions. Let's move it. What are the challenges in hedging strategies? So if always remember, hedging means derivatives and insurance. It will be very easy for you to remember what hedging is. Market volatility means the price of CDS will change depending upon the market. Counterparty risk. What if I have purchased the insurance from a company and that company itself defaults? Regulatory compliances after 2008, a lot of regulatory compliances came for derivatives. In next chapter, we are going to see that. Government does not allow anyone to use derivative products. Complex financial instruments. These CDS were so complex that most of the people who were trading in CDS, they could not understand what they were doing. Now, derivative products are in lots. Let's say lot of 100, lot of 1,000, lot of 500. So it's in lots. Now, if you just want to hedge 20 shares, you cannot do it because the lot is of 100 shares. So either you overhedge or you underhedge, because lot size is not same as what you want. So they have fixed lot sizes. We will see in derivatives what do you mean by lot size and other things. So right now, just remember that you do not generally get exactly what you want. So if you want to hedge 105 shares, you can either hedge 100 or you can either hedge 120. You cannot hedge complete 105. So that is overhedging and underhedging. And implementation risk. Now, you need to understand how it works and you need to implement it properly. Otherwise, rather than selling, many a times it so happen that you buy it because you do not know how to work in derivative products. So that is an implementation risk. Okay. How do you hedge operating risk, financial risk, and other things? So first of all, what is operational risk? We have already seen that, so I'm not going to spend time on this. We've already seen financial risk. We have seen pricing risk. What does pricing risk means? The cost. Let's say the cost increases by 10%. And you are in price elastic market, wherein if you increase the price by 10%, you're going to lose the market share by 20%. Now, this is very risky. So what you do, you try to hedge your cost. I always take an example of wheat. Now, the cost of wheat might increase, might decrease. You do not know. So you try to hedge it. How do you hedge? By using derivative products. Now, future forwards are types of the derivative products. We will see how you can work it out. But to give an idea, both future and product forward are same. Only the thing is, forwards are over the counter and futures are exchange traded. Now let's see how it works. Just in 5 minutes. Let's say you are a farmer and there is a factory owner. You sow wheat and the factory owner wants wheat. You will get wheat after 3 months. Now, you enter into a contract, farmer enters into a contract with factory owner to sell wheat after 3 months at a price of 20 rupees per kg. Just assume this. So a contract between farmer and the factory owner for a future date at a prefixed price at a prefixed quantity is called forward contract. Look again. A contract between a buyer and seller for an asset at a prefixed price, at a prefixed quantity on any future date is called forward contract. So they entered into a contract at 20 rupees for 100 kg after 3 months. So no matter after 3 months, whatever is the market price, even if the market price is 30, the farmer will sell to the factory owner at 20. What are the benefits? The benefits is that the farmer knows that his total cost is 10 and he is happy to sell it at 20 because his all costs are taken care of. And he will be able to sleep properly because he knows that he is going to get rupees 20. Similarly, factory owner is also worried that after prices might go up. There is a Ukraine war going on, so the wheat, Ukraine is one of the largest producer of wheat, so the chances that the wheat price might go up. So factory owner wants to fix the price. So he will also fix the price at 20 because he wants to sell flour at 30, his other costs are just 5, and he will earn a decent profit of 5 at 20 rupees. So both of them come together and they fix the price. So the risk of farmer is reduced, the risk of factory owner is reduced no matter what the market price is. So the contract between the buyer and seller for an asset at a prefixed price, at a prefixed quantity, at a future date is called forward contract. Now, let's say the market price became 50. The farmer has made a contract to sell at 20. The chances are that the farmer will go in market, sell it at 50, and he will not complete the contract. This is called counterparty risk. The farmer will run away. Now the factory owner will have to go in court and he will have to fight the battle. Therefore, in forward contract, there is a counterparty risk that another party who is in loss might run away. Therefore, the government come in between and they establish exchanges like MCX. Now, the contract which happened on MCX or NCDEX is a contract between these two people. Only the thing is, there is an exchange in between who takes care of counterparty risk. And how does exchange take care? With the help of mark to market. So only difference between forward and future contract is that forward is over the counter, means farmer and factory owner, they find each other and they do contract. That is over the counter. And exchange traded means there is a government regulatory body who looks after all these contracts. And those are called future contract. That's the difference between forward and future contract. Now, is there any question on this?
Forward contract, that is, we have known that is contract farming concept. It is based on forward contract scenario.
Yes, it is. Contract farming is based on forward contracts. True that.
Okay.
Okay, let's move it. Now, foreign currency risk. This you have forward and future contract in currencies also. So you can decide the currency exchange rate. So $1 is equal to 83 rupees after 3 months. You can fix the rate also. And that is a forward contract. If you directly go and find some person who exchange the currency, and if you go via exchanges, so NSC has an exchange which trades on currency. If you go via exchanges, then it becomes future contract. So you can hedge your revenue. You know that you are going to get 10 million after 6 months. So you can hedge this 10 million right now. You can hedge balance sheet. So balance sheet hedging means hedging of assets and liability. This is generally done by banks. The assets of banks are generally loans. So they give this loan to third party. That is balance sheet hedging. And the third party pays right away. So revenue hedging, balance sheet hedging, these are the examples. Interest rate risk, we have already seen interest. So you have floating rate and you have fixed rate. So conversion of floating rate to fixed and fixed rate to floating is called interest rate swap. We will see these are again derivative products. And with the help of interest rate swaps, you can hedge the interest rates. So you feel that, okay, the interest rates are increasing continuously. So you can you can convert your interest rate to fixed. So you will be paying just 7% every year, no matter what's the interest rate. That is called fixed interest rate. Floating means depending upon the changes in interest rate, your interest rate will change. That is floating interest rate. And with the help of swaps and options on the swaps, you can hedge interest rate risk also. Then static hedging is one-time hedging. Dynamic hedging is continuously hedging. So only understand these two terms. Static is one time, and dynamic, you change your positions every time. That is dynamic hedging. You need to consider, okay, additional consideration, you need to consider time while hedging. You need to consider complex financial accounting. I'm really sorry to say, but in India, derivative accounting is still a Pandora's box. It's been more than 10 years where active derivative trading is going on in India, but still derivative accounting is very, very difficult. The income tax rules are difficult. So if you trade in derivative, it becomes your business income. If you are in loss just by 1 rupee also, you need to do audit. So what people do, even if they are in loss by 1,000 or 10,000, even in 1 lakh in derivative trading, they do not want to go in audit, so they show a profit of 100 rupees in derivative trading. Because they want to run away from audit. How you can do that? You enter into contract with your friend and show that you earn 1 lakh rupees in that contract. So all derivative trading is a business income here in India. So you need to really work hard if you are a CA who is working in financial accounting. So a lot of CA now also reject derivatives accounting because the rules are not clear. Again, the taxations, there is a lot of taxation issue. In business income, if your income is less than if your revenue is less than 2 crore, you can use ATCCD, which says that you just need to show 6% of your revenue as profit and you need to pay tax on it. If you have cash income, then you need to show just 8% of your revenue as profit and you are happy. No need to do complex accounting. But there is no, say, what's the revenue in derivative. So nowadays, every CA has decided absolute sum of profit and loss is revenue. What does that mean? So if you lost 200 rupees today, take it as a positive. If you gain 100 rupees, take it also as positive. So add all your losses and profit, and that will be your revenue. And if it goes beyond 1 CR or beyond 2 CR, then you need to do audit. Otherwise, 6% of your revenue. So let's say my revenue came to be 1 CR, then I just need to show as 6 lakhs as my profit, and first 3 lakhs will be tax free, and then you need to pay 5% and 10%, and then depending on that you need to pay tax. But still, again, revenue recognition for taxation purpose for derivatives is not known in India also. I'm not sure about other countries, but in India, this is a big issue for derivatives. And a lot of cases are going on in Supreme Court regarding the same. The impact of risk management tools. Now, when you do risk management, you need to look for all other things like stop loss, notional value, maturity. This is for bond, maturity and gap. So we will see bonds also. These are option Greeks. So option Greeks are the values by which the option price changes. These are option Greeks. Basically delta, vega, rho. Just remember the names. We will see all those things. VAR stress testing, scenario analysis. Okay. Perfect. Nothing here. Okay. Fine. What are the various derivative contracts? Basically, futures, forwards, options, swaps, and CDS. These are only things in your syllabus. We have already seen futures and forwards. We have spoken about swaps, but we are going to see all of these in details. Right now, these are just the names for you to remember. Nothing else. Fine. Fine. Okay. What are the benefits? Derivative liquidity. It gives a lot of liquidity. Derivative contracts are liquid, especially if it is on exchange traded. It helps you in risk management. It helps in price discovery also. Now, there are many complex products whose price cannot be derived directly. Like, let's take a simple example. Price of gold. How do you price the gold? So, the gold price are determined with the help of buyers and sellers. So when there are a large number of buyers and large number of sellers, you will find the true price. So derivative contracts are used for price discovery. For many products, whose price cannot be calculated as cost plus profit. So for price discovery, derivative products are used. For customization, yes. You need to decide after 3 months, you need to decide after 3 months you want to exchange $10 million to Indian rupees. So you can enter into a derivative product at your own conditions. So you can enter for 25 days also, you can enter for 26 days also, you can enter at 55 days also, and you can decide the price along with the counterparty. Let's say the price is 83 or 84 and so on and so forth. So a lot of customization can be done with the help of some of the derivative product. I'm not saying all, but some. The second chapter is done.